Hi, I'm Eric Lay, and I'll be taking you through adjusting journal entries very quickly so I can emphasize the key and subtle aspects which you may not recognize. So I suggest that you pause and also repeat the content provided in this screencast. In financial accounting, there are two possible bases in which accounting information can be recorded. The aspect to look out for is the difference between the timing of when revenues and expenses are recorded. The purpose of this topic is to achieve a better representation of income, but which basis is better? Well, the Australian Accounting Standards Board has developed the generally accepted accounting principles in Australia, which requires the revenue recognition principle and the matching principle to be upheld. That is, recording revenues when they are earned and recording expenses in the period they are incurred. Due to this, accounting information under the cash basis is prohibited, thus requiring the use of the accrual basis as principles are not violated. When performing an adjusting entry in the general journal, it must be understood that the cash account is never affected in the adjusting process. The reason for this is that there are timing issues when recording revenues and expenses. Although you may often see the cash account in the general journal, you should note that this occurs before the end of the financial period or after, depending on the scenario provided. Since adjusting entries always involve and affect a revenue or expense account, it is fundamental that you are familiar with the normal balance of each account. You can easily remember this by thinking of the word dealer. Also, keep in mind where you find these accounts in financial statements. Now consider these four scenarios that are grouped into categories of revenues and expenses. Also direct your attention to keywords such as before and after. Once again, these keywords indicate to us the timing issues which we are attempting to correct through adjusting entry. For deferred revenues, when cash was received first and there is unearned revenue, an adjusting entry is needed to record how much revenue has so far been earned out of the unearned revenue. This was recorded at the end of the financial period, so that it satisfies the revenue recognition principle. For accrued revenues, when cash was received after providing the revenue, that could be a service. An adjusting entry is needed at the end of the financial period to record how much revenue the business has so far earned. For deferred expenses, when cash was initially paid to acquire the asset, a journal entry is recorded. However, an adjusting entry is needed to record the expenses that have occurred after the acquisition of the asset. For accrued expenses, when expenses have been incurred, but the end of the financial period occurs before the period it must be paid off, an adjusting entry will record the expense which has been incurred. So how do we apply this knowledge? Although the adjusting entry process is just a segment within the accounting cycle, it should not be forgotten that its main purpose is to represent accounting information more accurately, which is later used to produce financial statements. And this concludes our lesson.